ये तुम्हारा तुम्हारा माइक्रोवेव स्टीव शेयर में इंक्लूड ऑडियो
है प्रार्थना गुरुदेव से ये स्वर्ग संसार हो, अति उच्चतम जीवन बने, परमार्थमय व्यवहार हो। ना हम रहे अपने लिए, हमको सभी से गर्ज है, गुरुदेव ये आशीष दे जो सोचने का फर्ज है। हम हो पुजारी तत्व के, गुरुदेव के आदेश के, सच प्रेम के नित नेम के, सधर्म के सत्कर्म के, हो चीढ़ झूठी राह की, अन्याय की अभिमान की, सेवा करन को दास की, परवाह नहीं वो जान की। छोटे न हो हम बुद्धि से, हो विश्वमय से ईशमय, हो राममय और कृष्णमय, जगदेव में जगदीशमय। हर इंद्रियों पर ताब कर, हम वीर हो अति वीर हो, उज्ज्वल रहे सर से सदा, निज धर्म रथ खंबीर हो। अति शुद्ध हो आचार से, तन मन हमारा सर्वदा, आध्यात्म की शक्ति हमें पल भी नहीं कर दे जुदा। इस अमर आत्मा का हमें हर श्वास भर में गम रहे, गर मौत भी आ गई, सुख दुख हमसे कम रहे।
Good evening, everyone. Today's Saturday class topic is Treaty Basics and Overview of Tax Convention. Our keynote speaker is CA Yogesh Parwal sir. He is a direct tax professional with over 10 years of experience in handling international taxation, corporate taxation, individual taxation, and cross-border transactions. He has worked for BMR Advisors and Big Four. And now he is currently partner in Karani & Company. I would request sir to please give us a brief intro of the talk.
Thank you, Survi. So, see, guys, our topic for the day is that it's a overview of tax convention. Why an overview of tax convention? Because if you have to go through the entire articles of a tax convention, it would take more than 30 days. Because there are many articles, as good as 31 articles are there in a tax convention. What is a tax convention? A tax convention is precisely a contract and agreement between two contracting states. Two contracting states means a state of India and a foreign country. It's a tax convention. So it's an agreement between a two state which allocate the right to tax income and capital. So if we talk in context of India, India has as many as I think 115 or 116 tax conventions with various countries. I think there are more than 200 countries in the world, and and India has near about 100 plus comprehensive tax agreements and near about 7 to 8 limited tax agreements. We'll come what is the meaning of limited tax agreements and comprehensive tax agreements. But precisely a tax convention is an agreement between India and a foreign country which decide that on which income or capital India will get a right to tax and on which income and capital the other country will get a right to tax. It could even be possible that both the countries decide that yes, on this particular income, both the countries will tax it. Both the country will levy their taxes, but they will mutually decide that what rate will be applied on that income and the other country will apply at what rate. The overall objective of entering into a double taxation is primarily to eliminate, avoid, reduce double taxation. Because, for example, if India taxes an income at a rate of 30% and the US also taxes that income at 30%, so a person who is earning income has to pay 60% taxes, which is too much on that person. And therefore, the countries enter into a unilateral, a bilateral agreement, not unilateral, bilateral agreement to decide that India will yes tax an income or US will tax an income. First, they will decide that. If they decide that both of them will tax, then they will also decide that at what rate it will be taxed. So precisely, this is the entire concept of a tax treaty. And from where the power comes to for India, from where the power comes to enter into a tax treaty. This is given by the Constitution of India. Constitution of India allows you, provides to levy taxes on income. Due to that, Income Tax Act has been enacted. Income Tax Act has a particular section which is called Section 90, which provides that the central government or any person who's notified by the central government has the power to enter into a tax convention between India and the other country. So by virtue of Section 90 of the Income Tax Act, a double taxation avoidance agreement is entered. Now, how is it entered? Because we really don't know what is the process, but the details of the process. But how a tax convention is entered into, there are negotiations which firstly happens between Indian diplomats and a foreign diplomat, that they both come to a round table discussion. They say that yes, we have to enter into a tax treaty. Then they say that, okay, how you want to enter it? There has to be some guidance for entering into a tax treaty because it's not a simple language, it's an international agreement. So there are guidances which are available for entering into a tax treaty, which the speakers will cover. Precisely the OECD model, UN model, US model. So there are three models which gives a layout or a framework that yes, a tax treaty has to be entered into this format. So these are the guidances. So the diplomats using those guidances frame a tax treaty. So India will put all those things into a tax treaty which is favorable to India. The other country will put all those things into a tax treaty which is favorable to their residents and nationals. Now both the diplomats, Indian diplomat and the foreign diplomat, come to a round table. They discuss, yes, on this income, India will get a right to tax. On another income, the foreign country will get the right to tax. Now, who decided? They both do a negotiation, and the country which has strong power can lead the discussion. So, for example, like US is a developed nation, so everyone wants to get into a tax treaty with US. So US has a better bargaining power, bargaining capacity as compared to any other country. In terms of India, these days Indian economy is also growing, flourishing, and countries want to enter into a tax treaty with India and get into an allocation rate. So India also has a good bargaining power. So depending upon the negotiation which happens into a roundtable conference, they decide that both of them will get a right to tax. Then an instrument is drafted. That instrument is presented to the domestic law. It is ratified, means it is enacted into a by issue of a notification. Then the procedure of ratification is communicated to the other party, other foreign country, saying that yes, my domestic procedure have been fully completed. Now the treaty can be given into force. Then a notification is issued under Section 90 that yes, by that notification, the treaty has now come into force. Now, if a treaty comes into force, what will happen? Why you and I are not governed by a tax treaty? Why? Because you are also a resident of India. I'm also a resident of India. Why we are a resident of India? Because we stay for 182 days or more in India. But if you are a non-resident, I am a resident. Then, in addition to the Income Tax Act, one more law which is applicable is a tax treaty. So, for example, if you are a resident of US, I'm a resident of India, and you have earned an income, a resident of US has earned an income, then the US double taxation avoidance agreement also comes into picture. Apart from the domestic law provides you a taxation. But if a international law, which is a double taxation avoidance agreement, comes into force, then the provisions of that international law also have to be seen in addition to the Income Tax Act. And whichever is more beneficial, that will be applicable to that US resident. This is also coming out of Section 90, subsection 2. So precisely a double taxation avoidance agreement has many articles, 31 articles, which have few substantive provisions which allocates or decides that how an income will be taxed, which kind of income, business income, capital gain income, dividend income, royalty fee for technical services, income from immovable property, etc., etc. Other income. There's an article of other income also. So these tax treaties precisely decide that how the allocation of taxation of income and capital will be there, and this is the basic intent for which a tax treaty is entered into, and of course it helps in is boosting the economic relationships and improving the trade relationship between the two contracts. With this limited background, I'll ask the speakers to present the today's topic. They have prepared a slide deck covering various main articles, because it's an overview of a tax treaty, because each and every article can take a lot of time. So a broad guidance on what is a tax treaty, how it is framed, what are the articles, how a capital allocation or income allocation is done. And with this, you will get an overview, a bird's eye view on a double taxation avoidance agreement which India has. Over to you.
Is divided into 5 parts. First is the intro to tax treaties. Second is the model tax convention. Third is the overview of tax treaty. Fourth, steps when referring to tax treaty. And fifth is we'll study some case studies. So first of all, what is tax treaty? So basically, it's an agreement between two or more countries to decide how will they tax a certain type of income that crosses their border. These treaties help to prevent double taxation, where someone could end up paying tax on the same income to more than one country. Tax treaties can be limited as well as comprehensive. So limited means when only some articles are applicable to the other country. And comprehensive means when the whole treaty is applicable to the other country.
All the articles
All
of
the articles
treaty
are applicable to the other country. I'll give an example.
Stop sharing करके preservation. So now we
Basically, income tax India की ये site है, and here we first see limited agreements. So basically, इसमें only कुछ articles of the treaty is applicable to the other country. Basically, only 8 articles are there in India. First of all, is with Afghanistan. So in this agreement, basically, the aircraft, basically any aircraft of Afghanistan when crossing the Indian border, it will generate some income. Then the income will be taxable to Afghanistan. So it is a very limited, because only the income which is generated from aircraft, it will be taxable in Afghanistan. And comprehensive agreements is where the whole is taxable in Armenia contracts with Australia. In these countries, the whole articles of treaty are applicable. There are two types of treaties, bilateral and unilateral. Bilateral is the treaties between two countries, and multilateral is treaty between three or more countries. So now the first question is, why are tax treaties? So the first is prevention of double taxation. As discussed by sir earlier, the main motive of tax treaties is to avoid double taxation. The same income can be taxed in the resident country as well as the another country. So the main motive to have tax treaties is to prevent double taxation. Second is to promote cross-border trade and investment. Basically, in this type, by this tax treaties reduce the tax barriers and eliminate certain uncertainties relating to tax treaties, which encourages business and individual to engage in international transactions. Third is to avoid tax discrimination. Sometimes discrimination on base of nationality or residency can exist, so tax treaties avoid these type of discrimination. Fourth is to promote economic development. For developing countries, tax treaties can play a crucial role in attracting foreign investment and technology transfer by providing favorable tax treatment for non-residents. So, these sparing provisions, for example, allow foreign investors to benefit from tax incentives offered by the host country, which can encourage investment in infrastructure, industry, and other sectors contributing to economic growth.
Come to the previous slide. So it's written that the tax treaties help in preventing the double taxation, where some could end up paying taxes on the income in more than one country. So there are two types of double taxation. One is a juridical double taxation, and second is an economic double taxation. Now, what is the meaning of these two? Juridical means like jurisdiction. If the same income is taxed in more than one jurisdiction, that is a juridical double taxation. For example, a royalty income or a fee for technical service income is taxed in India also and is taxed in US also. So the same income is getting taxed at two different jurisdictions. Therefore, it is a juridical double taxation. So tax treaty helps in preventing juridical double taxation. How? The tax treaty will contain the rules under which either India will only get a right to tax or US will only get a right to tax. Or if both the countries are getting right to tax, then India, the right to tax which is there with India will be limited. So for example, in many of the tax treaties, the tax rate which is provided in royalty or fee for technical services ranges between 10% to 15%. Otherwise, an income in India is taxable at the rate of 25%, corporate tax 25, 30%. Whereas under a tax treaty, India has limited its right to tax that income only to the extent of 10% only. So that means the remaining power to tax that income will be governed by the another country. So a tax treaty helped in avoiding a juridical double taxation or limiting a juridical double taxation. That is one kind of double taxation. Second is economic double taxation. Economic double taxation means when the same income is taxed twice, but in the hands of two different people. Same income getting taxed twice, but in the hands of two different people is a economic double taxation. Example, dividend. Indian company declared dividend. Earlier, there was a dividend distribution tax regime. So dividend distribution tax was paid by the Indian companies. India got taxed, and the tax was levied on the Indian company. Now, when the dividend income was passed on to the shareholders would also have to again pay taxes based on their local laws. So different people. So same income that was a dividend income that was allocation of the profits to the shareholders was getting taxed twice on two different people. Once in the hand of the Indian company and second in the hand of the shareholders. So that is an economic double taxation. So DTAA helps in avoiding this kind of double taxation as well. So precisely juridical double taxation and economic double taxation is prevented or avoided through entering into a tax treaty, which is beneficial for the economy. Because in the next slide, we discuss what are the benefits of having a double taxation avoidance agreement.
Let's already discuss this topic. So juridical, in which the two or more countries try to tax the same income or profit. And in economy, the same income is taxed twice, but at different stages. Now, what are the models of tax convention? So basically, there are three models of tax convention. The second one is UN model, and the third is US model. So OECD stands for Organization for Economic Cooperation and Development. It was established in 1961 with developed country as its member. This provides a standardized approach for allocating taxing rights between countries and preventing double taxation of income. So basically, OECD model follows residence principle. So what is residence principle? The person who is the resident of that country will have the right to the country will have the right to tax that income in that country. UN model is the tax treaties between developed and lesser developed countries, or the countries which are developing. It was drafted in 1980 to encourage the flow of investment from the developed to developing countries. It follows source principle as its main. So what is source principle? The origin of income. The income, the country in which the income is originated, it will be taxed in that country. And most of the Indian tax treaties are based on UN model. That means it follows the source principle. US model is like a rule book for how two countries decide to tax income that comes from both places. Basically, US model is only applicable to US only. And this model of tax treaty covered things like business profit, dividend, interest, and royalty. The model convention of tax treaty. First is it aids negotiation of tax treaty. So the country which has the more negotiating power will be able to tax the income which has been earned. So as sir explained earlier, that US has more negotiating power. So because it is a more developed country, that is why US has more chances to tax the same income which can be generated in India. Second is make treaties uniform. So these tax treaties help to promote consistency and uniformity in tax treaties across different jurisdictions. While each treaty will vary based on the specific needs and priorities of the countries involved, having a model convention ensures that there is a basic level of coherence and similarity in the structure and provision. Third is it aids in interpretation. So these conventions provide guidance for interpreting and applying the provision to tax treaties. Basically, they clarify the meaning of various terms and the concept used in these treaties. This helps in ensuring consistent interpretation and application of tax treaty provisions, which can help prevent disputes and double taxation. So basically, these are the advantages of the tax treaty. Now, there are 31 articles in tax treaties. The ones which are highlighted, we'll discuss them only. Now, what are the general principles of tax conventions?
Come to the previous slide. So see, if we broadly look at what are the various, the framework or a construct of a tax treaty. One is the scope provision. Article 1, 2, 29, and 30. These precisely tells us about the scope of a tax treaty, that who all are covered, what all kind of taxes are covered, when the tax treaty entered into force, and what is the termination article if a tax treaty has to be terminated. Then second is elimination of a double taxation, which means that there is an article 23 which says that how it would be eliminated. Then we have a miscellaneous provisions which are like non-discrimination provisions, assistance in collection of taxes related to diplomats, and textutorial extension, which we practically don't use them a lot. Then these are the definition provisions, anti-avoidance provisions, and substantive provisions. Most important are, of course, the substantive provisions, because these are the income in which a country decide that who will tax what. Income from immovable property, business profit, shipping aircraft, dividend, interest, royalty, FTS, capital gains, IPS, DPS, director who are earning income, artists and sports person who are earning income, pension income, government services income, students who are earning income, and other income and a capital income. So substantial provisions precisely allocate the taxing rights between the two states on what all kind of income and capital which is listed over here. So these are the main substantive provisions. Definitions, there are few definitions which are provided in a double taxation avoidance agreement, which we'll deal later. And there are anti-avoidance measures. These anti-avoidance measures are precisely inserted so that a person or a country does not misuse a tax treaty. Because there have been cases in the past wherein some entities got established or some company established themselves into a tax haven, and then investment came into India. And by virtue of the treaty provisions, they were taking exemption from the income tax. Or in other words, round tripping. Someone has a lot of money in India. Right? If that money is invested, that would be taxed. But if that money goes outside India, and then by establishing an entity into a tax haven country, for example, earlier it was Mauritius, Ireland, other jurisdiction, if that money again comes back into India, and that by routing this money from a tax haven country and applying a tax treaty, the income is not chargeable to tax no more in India. So you have precisely did a round tripping of funds and taken a benefit of a tax treaty. In order to prevent these kind of arrangements, which were earlier done, these anti-avoidance provisions have also been inserted into a tax treaty. There is a limitation of benefit article also, like Article 26 is exchange of information. In some of the treaties, there is a limitation of benefit article also, which says that benefit of the article will be limited, will not be granted if these kind of activities have happened. So these are anti-avoidance measures are also important. Entitlement to benefits is one of the articles that deals with it. Now we'll discuss these basic articles which have been highlighted in yellow.
General principles of tax conventions. So these are also known as double taxation agreements, DTAs, or tax treaties. They establish the framework for how countries cooperate on tax matters. So the first principle is residency principle. So basically, the person जो जिस country का resident है, तो वो income उस country में taxable होगी. This is residency principle. Second is source principle, the origin of the income. जिस country में वो income originate हुई है, वो वहाँ taxable है. Third is the elimination of double taxation. So primary objective of tax convention is to avoid double taxation. ताकि the same जो income जो generate होती है वो दोनों countries में taxable ना. And the fourth is non-discrimination. So basically discrimination on the basis of nationality, residence या any other factor. इन सबको avoid करने के लिए tax treaties are formed. Exchange of information. The fifth one is exchange of information. So tax conventions typically include provision for exchange of information between tax authorities to prevent tax evasion and ensure compliance with tax laws. Basically, this facilitates transparency and cooperation in the tax matter. The fifth one is mutual agreement procedure. It is also known as MAP. So these provide mechanism for resolving dispute between two countries regarding the interpretation and the application of the treaty. The sixth one is anti-avoidance measures. So basically, to prevent tax evasion and abuse of the treaty benefits. These treaties are formed. So it ensures that taxpayers do not misuse the provision of the treaty to avoid paying taxes or engage in aggressive tax planning. The last one is cooperation and assistance. So these tax conventions promote cooperation and assistance between tax authorities to facilitate the administration and enforcement of tax law. This includes provisions for mutual assistance in tax matters such as collection of tax and exchange of information. Basically, these are the functions जो tax treaties हमें provide करते. Next is international law, the Vienna Convention. So basically, this is a rule book which define how countries should make treaties, follow them. The main purpose for this convention, like why this convention was formed, it was formed to determine how treaties should be made, understood, and followed. The scope of this convention is between countries or financial institutions, international organizations. The third one is for how these treaties are formed. So this Vienna Convention explain how treaties are made, what makes them valid, and how countries should agree to be bound by them. How these treaties are interpreted. This convention set rules for understanding what treaty means, like using good faith and looking at the additional clues to understand their intent. Reservation. If a country wants to add their own conditions or exceptions, these are known as reservations. And how countries should react to these reservations, the convention tells. So basically, India is not a member of this convention, but it has entered into this convention for international juridical purpose. And important articles of this convention, which has been used by India, are Article 26, 27, and 31 to 30. Overall, this convention helps countries to work together smoothly by providing clear guidance for making, understanding, and following. Now, we'll start with Article 1. Article 1 defines who are the persons covered under this tax treaty. So basically, OECD and UN model are very much similar. They does not have very much difference. So Article 1 defines that residents of the contracting states and covers tax on income and capital imposed by each state. In simpler terms, it means that treaty is applicable to people living in the countries involved in tax they pay on their income and wealth. Article 3 defines person. Now, person is individual, company, or any other group recognized as taxable entities under the respective tax law. It includes not just individual and companies, but also any entities that are treated as taxable units under tax laws of each country. Now, the persons covered resident. The UN model is applicable only to the persons who are resident of one or more contracting states. Article 4 of this OECD or UN model defines residents of a contracting state as anyone who is subject to tax in that state based on the factors like domicile, residence, place of management, or similar criteria. Person covered partnership. So under OECD principles, a partnership may be considered a person, but not necessarily a resident in the context of tax treaties. This distinction arises due to different tax treatments, whether the partnership is transparent or non-transparent. So basically, transparent partnership is that partnership in which proper deeds and the necessary documents are made. And the non-transparent partnership is that which doesn't have deed or the other documents which make them legal. The key principle of this includes for treaty benefits, a partnership must qualify a residence of a specific country. Partners can only gain treaty benefits if the partnership is transparent in the country of residence. The treatment of the partnership in the source country is irrelevant for determining treaty benefits. So basically, यहाँ source principle काम नहीं करता, resident principle काम करता है. अगर partnership इंडिया का resident है, मतलब वो transparent है, तो वो income इंडिया में taxable हो. These principles aim to address issues like double taxation and ensure fair treatment of partnership under tax treaty. So partnership में सिर्फ residency principles आता है. Now, what are the taxes covered under this convention? So basically, taxes on income and capital imposed by a contracting state or its subdivisions, irrespective of the manner they lend. So, taxes on income or capital जो कि contracting state ने लगाए हैं, irrespective of कैसे भी manner में लगे, वो सारे taxes इस tax treaty में cover हैं. Basically, direct taxes ज़्यादा covered है in tax treaties में, indirect taxes are typically excluded. The focus is on direct taxes, aliening with the common territory practice. Now, what are taxes? So, tax majorly covers the following aspects: tax on income and capital, income levies on total income, total capital, or specific income or capital component. This includes taxes on gain from sale of movable or immovable property. Additionally, taxes on wages or salary, taxes on capital appreciation. So basically, tax on income and capital, tax on gain on sale of immovable property or movable property, tax on wages or salary. These three are covered under the definition of taxes. As said earlier, both the OECD and UN model are identical, working under this program. Article 2, subsection 2 define the taxes in Indian perspective. So basically, wealth tax, equalization levy, social security charges, interest and penalty, surcharge and education cess, dividend distribution tax, buyback tax are included. But acquisition levy, social security charges, and interest and penalty are not covered under the tax rate. Dividend distribution tax and the last one are subject to tax rate. Basically, if tax treaty has mentioned that tax will be levied, then they will be.
So, like you want to know that surcharge and education cess is levied. Now, on the basic tax rate, the tax rate has to be topped up by surcharge and education cess. So that's a domestic law concept. Now, whether the tax rate which is provided in a tax treaty has to be increased by a surcharge or education cess is the question. Thoughts? So, see the tax rate which is provided uh, in the definition of taxes. It means taxes include income tax and surcharge and education cess. It's written in the tax treaty. So the courts have interpreted it to mean that the tax rate which is provided in a tax treaty is a final tax rate. This is not required to be increased by surcharge and education cess. Surcharge and education cess come by virtue of Finance Act. Every year a Finance Act comes. In the Finance Act, there are sections, and those sections provide that this would be the rate of surcharge and this would be a rate of education cess. The provisions of the Finance Act are per se not applicable to a tax treaty, and therefore the surcharge rate and the education cess rate, which is provided in domestic law, applies to the domestic law rates. It is not applicable to a tax treaty rate. So, for example, if a royalty FTS article provides a tax rate of 10%, that is a final tax rate that has not to be increased by surcharge and education cess. So, while making remittance of that income, withholding has to be done under Section 195. Now the question arises, okay, if a treaty provides a rate of 10%, so 10% is a rate which is provided under a treaty. Now this has to be increased by a 2% surcharge and a 4% education cess or not. If a tax treaty is applicable, then it has not to be increased by the additional rate of surcharge and education cess. The tax treaty rate is a final tax rate.
The next article, 2 subsection 4, it defines the future tax. So the convention extends to taxes identical or substantially like those already covered. Basically, I have already defined the taxes: taxes on income and capital, tax on wages and salary, taxes on the sale of immovable or movable property. These taxes must share essential characteristics with existing ones in terms of basis computation method and the taxpayer's effect. The education cess, along with surcharge, falls under this provision. Contracting states commit to notify each other for significant changes in their taxation law, and there is no specified time limit for such notice. Now,
Meantime, Happy with this people. The screen share कर. उसको मैं start करती हूँ.
Now, further topics will be discussed by Radhika. So, good afternoon, everyone. Today, I'm going to continue with this topic only. So, let's start. The first topic is Article 3, which generally defines the general definitions. This article provides the meaning of various terms used in tax treaty. If a particular term is not defined in the tax treaty, Article 3 may provide that meaning of such term should be construed as per the domestic laws of that country. So basically, the first definition is a person. The term person includes an individual, a company, and any other body of person. So it's basically the UN model is identical, majorly identical to OECD model. Moving on to the next definition, which is of company. The term company means any body corporate or any entity treated as a body corporate for taxes purposes. Now, the next definition is of enterprise. The term enterprise applies only to the carry of any business. The next is the term enterprise of a contracting state and enterprise of other contracting state mean respectively an enterprise carried on by a resident of a contracting state and enterprise carried on by a resident of other contracting state. And in these three definitions, these are identical to OECD model in UN model. The next definition is of international traffic. The term international traffic means any transport by a ship or an aircraft operated by an enterprise that has its place of effective management in a contracting state, except when the ship or aircraft is operated solely between places in other contracting states. The definition of national is the term national in relation to a contracting means any individual possessing the nationality or citizenship of that contracting state and any legal person, partnership, or association deriving its status as such from the laws in force in that contracting state. So there's a difference in national definition of UN model. It doesn't include the citizenship of that word. So there's this difference only. Now moving on to the next definition of business. The term business includes the performance of professional services or of other activities of an independent character. Basically, there is no definition defined in treaty or of a UN model. So we can take the reference from the Income Tax Act, which is section 2. Now moving on to the next para, which is para 2. Article 3.2 implies that for terms which have not specifically defined in tax treaty, the applicable meaning of such word under the domestic law of that contracting state in which tax is being levied shall be considered if only one meaning is given, or if more than one definitions are given, then one for particular provision issue should be used. So basically, if a particular meaning is not given in tax treaty, but so we can take the definition of that word from the domestic laws of that particular country. So it basically talks about that. Moving on to the next article, which is Article 4, which defines resident. So basically, it is divided into three parts: a definition of a resident, tiebreaker rule for individual, and tiebreaker rule for other than individual, which is company. Definition of resident under OECD model is, for the purpose of this convention, the term resident of a contracting state means in person who, under the laws of that state, is liable to tax therein the reason of his domicile, residence, place of management, and any other criteria of similar nature, and also includes that state and any particular subdivision or local authority thereof. This term, however, does not include any person who is liable to tax in that state in respect of only of income from source in that state or capital situated therein. So basically, there's one difference in UN model. UN model also includes place of incorporation. So basically, the key highlights of Article 4.1 is Article 4 provides an exhaustive definition of the term resident and provides that resident means any person who is liable to tax in state under the laws of that state by reason of his domicile, residence, place of management, and any other criteria. And UN model includes place of incorporation as well. So basically, if a person is resident in both the contracting state and other contracting state, so there's this rule, tiebreaker rule, which works on this basis. If a person we will look for the permanent home, in which country he has his permanent home. If in both the countries he has his permanent home, then we look for the center of vital interest, which in which the personal and economic relations are closer. And if he doesn't have any center of vital interest in any of the country or have in both the countries, then we look for the habitual abode. And if habitual abode is when if he has both in both the countries, then we look for the nationality. And in nationality, if he has nationality of both the countries, then competent authorities by mutual agreement will decide his residence or the status of his residence. So the permanent home refers to a dwelling place available to a person continuously, even if it is taken on rent. Any place taken for a short stay or temporarily, like business travel or holiday, would not be included. Center of vital interest means closer personal economic relations like family and social relations, occupation, place of business, political, and cultural and other activities. Habitual abode. Habitual abode means the place where someone usually lives or stays for a significant amount of time. It's like your regular home or where you spend most of your time.
So this tiebreaker rule is applicable only for an individual, right? So come to the previous slide. Previous. Yes. So see, Article 4, it's a definition of a term resident, right? Now under the Income Tax Act, where is the definition of term resident? Which section? 6. Section 6 के अंदर there is a who is a resident of India, उसकी पूरी law is laid out. Section 6(1), 182 days or more in India, and then there are dual conditions of 60 days and 365 days in the last 4 years. Either of the two have to be fulfilled. For a corporate, it says that if it is incorporated in India, then it is a resident. So each and every country has some rules related to residence. Each and every domestic law of a country provides information on how and when a person will be treated as a resident. So income tax law have a particular rule. Similarly, for example, other country like US also has a residency rule where again it's 182 days or maybe whatever number of days are there. Now, if a person qualifies as a resident of both the contracting state, because in India, if a person stays in 182 days, that person is a resident. Now, if another country has a law of only 60 days, and if I travel to another country and I stay there for 60 days, I become a resident of that country as well. Now the tax treaty says, okay, you are a resident of both the tax treaties. Then the Article 4 residence, उसमें Article subparagraph 2 जो है, paragraph 2 जो है, Article 4 का paragraph 1, paragraph 2 and paragraph 3, 3 paragraphs है. Paragraph 1 is a basic law, जो कि ये था. Article 4 provides an exhaustive definition and provides resident means a person who is liable to tax therein in a state under the laws of that state by the reason of his domicile, residence, place of management, or any other criteria of a similar nature, and includes place of incorporation to the list of criteria. So, ये Article 4 का mother rule हुआ. If a person is a resident of a both a contracting state, तो फिर tiebreaker rules आए. Tiebreaker rule जो लगता है वो individuals के लिए है. Article 4(2) में उसमें 4 rules है. Number 1, permanent home का test. Second is center of vital interest का test. Third is habitual board. Fourth is nationality. And if all the 4 tests fails, then the competent authorities of the 2 contracting state will decide कि person कहाँ का resident है. Competent authorities of contracting state का मतलब होता है कि जैसे हर एक लॉ के अंदर वहाँ का एक कॉम्पिटेंट अथॉरिटी डिफाइन किया हुआ है टू डील विद द मैटर्स व्हिच आर अराइजिंग आउट ऑफ दिस. सो फॉर एग्जांपल सीबीडीटी इन इंडिया, उसमें डायरेक्ट टैक्स विंग, सीबीडीटी डायरेक्ट टैक्स सीबीडीटी, उसके अंदर जो गवर्नमेंट ने एक ऑफिस बना रखा है कि these all these applications will be dealt with this particular officers will deal all these applications. So ये जो 4 टेस्ट है, come to the next slide. ये जो 4 टेस्ट है, परमानेंट होम, सेंटर ऑफ वाइटल इंटरेस्ट, हैबिचुअल अबोर्ड, नेशनैलिटी एंड कॉम्पिटेंट अथॉरिटी बाय म्यूचुअल अग्रीमेंट. सो इफ अ पर्सन क्वालिफाइज एज अ रेजिडेंट ऑफ इंडिया एंड बाहर का भी वो रेजिडेंट हो गया, तो सबसे पहले देखते हैं कि उसका परमानेंट होम कहाँ पे है. परमानेंट होम का मतलब क्या हुआ कि उसका मतलब प्रॉपर होम जहाँ वो हमेशा रहता है वो कहाँ पे है. इसमें अगर आपने रेंटेड प्रेमाइसेस भी है तो वो भी है. फॉर एग्जांपल आई एम इन इंडिया, आई हैव अ परमानेंट होम हियर, बट मैं एम्प्लॉयमेंट के लिए बाहर चला जाता हूँ और वहाँ पे I stay in a residential rented premises. That rented premises is also regarded as a permanent home. So now I have a permanent home outside India as well as in India. So this test fails. Now comes the second test, center of vital interest. इसका मतलब ये होता है कि कहाँ किसी उस पर्सन के पर्सनल एंड इकोनॉमिक रिलेशनशिप क्लोजर है. So whether if I have my family in India, so my personal relationship are closer. But since I'm employed outside India और मैं वहाँ पे काम कर रहा हूँ, तो my economic relationships are closer because मेरे को वहाँ से salary income earn हो रही है वहाँ पे. So this test also fails. Then comes habitual abode, कि वो generally कहाँ रहा हुआ है. So उसमें देखते हैं कि for example I have lived in India for so many number of years, so my habitual abode to India is closer. Similarly, लेकिन अगर किसी केस में बहुत substantial time हो गया जहाँ पे habitual abode भी mix है, 20 साल इधर भी रहा, 20 साल उधर भी रहा, then you come to a nationality. मैं कहाँ का national हूँ? I am an Indian national, तो I am a resident of India. लेकिन अगर मेरे को दूसरी कंट्री में रहते हुए मेरे को वहाँ की भी नेशनैलिटी मिल गई, then this test also fails. Then जो दोनों कॉम्पिटेंट अथॉरिटी है वो आपस में आके बैठेंगे, डिसाइड करेंगे कि मैं कहाँ का रेजिडेंट. So these are the tiebreaker rules. ये क्यों हम डिस्कस कर रहे हैं? Because whenever एक नॉन रेजिडेंट इंडिविजुअल की टैक्स रिटर्न फाइल करने आता है और अगर वहाँ पे अपन अटक जाते हैं कि वो इंडिया का भी रेजिडेंट है क्योंकि 182 डेज से ज्यादा रहा और पता चलता है कि वो बाहर वाली कंट्री का भी रेजिडेंट है, then these rules have to be applied to come to a conclusion कि वो रेजिडेंट कहाँ का है. और उसके हिसाब से फिर पूरा टैक्सेशन उसका गवर्न होगा, पूरी टैक्स ट्रीटी लगेगी और इंडिया के पास राइट आएगा टैक्स का या दूसरी कंट्री के पास राइट जाएगा टैक्स का. इसलिए दिस आर्टिकल इज वेरी इंपॉर्टेंट टू डिसाइड कि वो रेजिडेंट कहाँ माना जाएगा.
So here comes the tiebreaker rule for other than individual or companies. So if a company is resident in both these contracting states, then we look for the place of effective management, where the place of effective management is situated. We'll decide the resident status of resident on that basis only. So let's come to the next article, which is Article 10, deals with dividend. Article 10 of OECD Model Tax Convention specifically addresses the taxation of dividend. Dividends are payments made by the company to its shareholder, typically out of the company's profits. The article outlines the rules and guidelines for how dividends should be taxed when the recipient shareholder is a resident of a different country from the company paying the dividend. So taxation of dividend under Article 10. Basically, there are two types of taxation, as could be discussed, is residence-based taxation and source-based taxation. Article 10 establishes the principle of residence-based taxation for dividends. This means that country where the recipient shareholder is resident has the primary right to tax the dividend, subject to certain exceptions and limitations. Under source-based taxation, the country where the company paying the dividend is a resident is also granted the right to levy a withholding tax on the dividends, but this time the rate is capped at a specific maximum percentage, which is between 10 to 15%. The balancing interest. The provisions in Article 10 aims to strike a balance between the taxing rights of the resident country and the source country, providing a framework for the efficient taxation of cross-border dividend payments. So there is a concept of beneficial ownership requirement in Article 10, where we'll decide whether the owner is beneficial or not. Who is beneficial owner? The reduced withholding tax rate provided under Article 10 only applies if the resident of the dividend is a beneficial owner. This means the person who has the right to use and enjoy the dividend income. So basically, the major implementation of this requirement is to prevent greedy abuse. The beneficial ownership requirement is intended to prevent treaty abuse, where a person who is not the true owner of the dividend tries to claim the reduced withholding tax rates by interposing an intermediary entity. Now, determining the beneficial ownership. The determination of beneficial ownership is based on the substance of arrangements and nature and true nature of economic relationships involved rather than just the legal form. Now, moving on to the next article, which is Article 11, which deals with the interest. Article 11 of OECD Model Convention covers the taxation of interest income. This article establishes the rule for how interest payment between the residents of two contracting states should be taxed. Scope of Article 11. The definition of interest. Article 11 defines interest as income from debt claims of every kind, whether or not secured or mortgaged, and whether or not carrying a right to participate in debtors' profit. This includes income from government securities, bonds, debentures, and other forms of debt instruments. There are certain exclusions which are excluded from the definition of interest. This article excludes certain types of income from the definition of interest, such as income considered as a dividend under Article 10 and penalties for late payments. These are instead covered under separate articles of the same treaty. Territorial scope. The scope of Article 11 applies to interest arising in one contracting state and paid to the resident of other contracting state. It governs the taxation rights of the two states with respect to cross-border interest payments. Now, definition, there's a deeper definition of interest, which is as follows. The first is debt claims of every kind. The definition of interest encompasses income from all types of debt claims, including government securities, corporate bonds, bank deposits, and other financial instruments that represent a debtor-creditor relationship. In secured or unsecured, interest income is covered regardless of whether the debt claim is secured by collateral or not. The key factor is existence of debtor-creditor relationship, not the specific nature of debt instrument. Participation in profits. Interest income is included even if it is granted to even grants the creditor a right to participate in debtor's profits. This distinguishes interest from dividends, which are covered under separate article, which is Article 10. Taxation of interest. Taxing rights. Article 11 allows the source country to tax the interest income. However, the residence country also retains the right to the same income. Withholding tax. The source income may impose a withholding tax on the interest payment, but the tax rate is limited to the cap specified in tax treaty, which is typically 10 to 15%. The residence country must then provide a credit for the tax paid in the source country. Residence taxation. The residence country has the right to tax the interest income as part of the residence renewable income, providing a credit for any withholding tax paid in the source country. This prevents double taxation of the same income.
So see, this is a the clear example of avoiding a juridical double taxation, because India also has a right to tax that income, and same income is also getting taxed in another country. But India has limited its right to tax at a rate of 10 or 15%. So most of the articles, dividend, interest, royalty, and fee for technical service, these are the most used articles of a tax treaty in daily life. Now, in all these 4-5 articles, the language is very similar with respect to avoiding the juridical double taxation, because उसमें इंडिया के पास एक राइट होगा टैक्स का, और जहाँ का वो रेजिडेंट है उसके पास भी राइट होगा. इंडिया के पास क्यों है राइट? क्योंकि सोर्स इंडिया में, वो जो इंटरेस्ट इनकम है वो इंडिया में अराइज हुई है, क्योंकि लोन किसी इंडियन कंपनी ने लिया हुआ है. लोन इंडियन कंपनी ने लिया हुआ है, तो इंडिया हैज अ राइट टू टैक्स इट, क्योंकि सोर्स इंडिया में, क्योंकि इंटरेस्ट इनकम इंडिया में जनरेट हुई है. लेकिन जो जहाँ का भी वो रेजिडेंट है उसके पास भी राइट है टैक्स के लिए. क्यों? क्योंकि वो वहाँ का रेजिडेंट है, क्योंकि वहाँ का ग्लोबल इनकम टैक्सेबल होती है जहाँ का भी रेजिडेंट होता है. तो दोनों कंट्री के पास राइट है टैक्स का, लेकिन इंडिया ने बोला कि मैं इस इनकम के ऊपर 10% से ज्यादा टैक्स नहीं लूंगा. सो इंडिया हैज लिमिटेड इट्स राइट टू टैक्स इट. एंड जब ये इनकम वहाँ पे आएगी, उस रेजिडेंट के ग्लोबल इनकम में जब शामिल हो गया, फॉर एग्जाम्पल वहाँ पे 20% की टैक्स रेट है, तो जो इंडिया में 10% का टैक्स पे किया उसको वहाँ क्रेडिट मिल जाएगी, तो केवल डिफरेंशियल 10% ही पे करना पड़ेगा. अगर ये ट्रीटी नहीं होती तो इंडिया में भी जो भी डोमेस्टिक लॉ का रेट लगता 20%, 25%, 30% वो लगता, और वहां पे भी रेट लगता. तो एक ही इनकम के ऊपर 60% का टैक्स जाता, लेकिन DTAA होने के कारण इंडिया में 10% का टैक्स लगा केवल, और अगर वहां पे 20% की रेट है तो वहां पे भी केवल उसको 10% का टैक्स देना पड़ा, तो ओवरऑल उसका 20% का ही टैक्स लगा, और DTAA नहीं होता तो इट वुड हैव बीन गॉन अप टू अ वेरी हाई रेट. सो दिस इज द बेनिफिट ऑफ हैविंग अ डबल टैक्सेशन अवॉइडेंस एग्रीमेंट. और अगर ये होगा तभी तो कैपिटल आएगा, तभी FDI आएगा, तभी इन्वेस्टमेंट करना चाहेगा, क्योंकि जो भी इन्वेस्टमेंट लेके आएगा they will also take into picture कि what is the tax angle to the income that they earn. If they end up saying कि taxes में सारी income उनकी अगर जा रही है, so they will not get business, they will not invest, and therefore double taxation avoidance agreement helps in avoiding tax twice on the same income. So this is a concept of limiting or reducing the juridical double taxation.
Moving on to next article, which is Article 15, which deals with the capital gains. Article 13 of the OECD model provides guidance on the taxation of capital gains, which refers to the profit and losses realized from the sale and exchange of assets such as real estate, stocks, and other investments. Now, what is the scope of Article 13? First, immovable property. Article 13 primarily focuses on taxation of gains derived from the alienation of immovable property such as land and buildings. The article provides guidance on the allocation of taxing rights between the resource and resident states. Movable property. Movable property includes property such as shares and interest in partnership and other type of personal property. The allocation of taxing rights in these cases can be more complex and often depends on the specific circumstances. There are certain exceptions and limitations which are not included in Article 13. Article 13 recognizes certain exceptions and limitations such as treatment of gain from alienation of ships, aircraft, and other modes of transportation used in international traffic, such as well as gains derived from alienation of property forming part of business property of permanent establishment. Taxation of immovable property. Under source-based taxation, Article 13 generally grants the right to tax gains from the alienation of immovable property to the state where the property is located. This ensures that the state where the real estate is situated has primary taxing rights over the associated capital gains. Resident-based taxation. However, the article also acknowledges that the state of residence of a taxpayer may have a legitimate interest in taxing these gains, particularly if the taxpayer has held the property of an extended period. In such cases, the article provides a credit or exemption mechanism to avoid double taxation. Exceptions and special cases. Article 13 also addresses specific situations such as the taxation of gains from the alienation of shares in companies whose assets are predominantly immovable property. The article provides guidance on how to determine the appropriate taxing rights in these more complex scenarios. Taxation of movable property versus business property. Gains from alienation of movable property, that, for example, like a vehicle of a company that is a part of business property of permanent establishment, are generally taxable in the state where the permanent establishment is situated. This ensures that the state where the economic activity is conducted has the primary taxing right. Shares and interest. Gains from alienation of shares, interest in partnerships, or other types of movable property may be taxable in the state of residence of the taxpayer or the state where the property is situated, depending on the specific circumstances and the provisions of applicable tax treaty. There are certain exceptions. Article 13 also addresses exceptions such as taxation of gains from alienation of ships, aircraft, and other modes of transportation used in international traffic, which are typically taxable only in state of residence of enterprise operating the transportation business.
So in this, shares and securities, there was a famous rule which was called the Mauritius rule. Earlier, the FDI investments used to come from Mauritius. Why Mauritius? It's kind of, but there is a more deeper reason to it. Why Mauritius? Because prior to April 2017, the DTAA between India and Mauritius said that any income which is arising from alienation, alienation का मतलब transfer of shares, any income which is arising from transfer of shares will be taxed only in Mauritius. उसमें लिखा हुआ था कि इंडिया के पास राइट नहीं है कैपिटल गेन्स को टैक्स करने का, तो किसके पास है? मॉरिशस के पास है, और मॉरिशस में कैपिटल गेन्स टैक्स है ही नहीं। तो जो भी इन्वेस्टमेंट वहां से आता था, और अगर उसके कोई भी एक नॉन रेजिडेंट अगर शेयर ट्रांसफर कर रहा होता, तो इंडिया के पास टैक्सेशन राइट नहीं है, तो इंडिया के पास टैक्स नहीं आया। मॉरिशस में कैपिटल गेन्स टैक्स लगता नहीं है, तो मॉरिशस में टैक्स नहीं लगा, तो वो पूरी इनकम क्या हो रही थी? टैक्स फ्री जाती। तो इसके ऊपर बहुत डिबेट हुई, एंड दिस आर्ग्यूमेंट और जो भी कैपिटल गेन का जो था, इट वेंट अप टू द सुप्रीम कोर्ट ऑफ इंडिया तक ये गया था, और उसके अंदर यही पॉइंट ऑफ डिबेट था कि ऑल दिस काइंड ऑफ अरेंजमेंट, द फेमस सो कॉल्ड मॉरिशस रूट, ये जो रूट है, whether this is a tax planning for avoidance of taxation, or is it a legitimate within the four corners of the law, ये पूरे tax ये कर सकते हैं। So the Supreme Court said that, see, what is a tax free? It is, like we said we discussed in the starting, it's a negotiation between two countries. India Mauritius tax treaty, I think somewhere in 1995 या उसके आसपास enter हुई। At that time, India needed FDI, and I think in 1991, Prime Minister Manmohan Singh at that time opened the gates of India for FDIs as well. Foreign direct investment तभी से आया था। India wanted a lot of FDI for its development. So the Supreme Court said that genuinely, legitimately, India has foregone its right to tax the capital gains which is coming from Mauritius, and therefore you cannot say कि non-resident Mauritius से आ रहा है और उसको he is using it as a tax evasion tool. India has foregone the right, and you have to respect that written in the tax treaty. आप ये नहीं कह सकते, even if it is written in a tax treaty, you cannot say the Indian revenue पर क्या claim था, pay taxes in India on that capital gains. और taxpayer कहता था कि I'm not liable to pay capital gain taxation because I'm a resident of Mauritius, and since I'm a resident of Mauritius, तो India में tax आना नहीं चाहिए, और capital gains tax exempt है क्योंकि India does not have a right to tax that income. So Supreme Court said that all those have to be respected. आप केवल ये नहीं कह सकते हो कि कहीं टैक्स नहीं जा रहा है इसलिए टैक्स इवेजन है। India has purposefully foregone its right to tax, and therefore the non-resident cannot be compelled to pay taxes in India from Mauritius, जो भी Mauritius का tax resident। From April 2017, 1st April 17 को treaty change हुई। कैसे change हुई? Indian government के diplomats, Mauritius government के diplomats वापस आए। Up 2017 was a different scenario for India. India was on a league of a developed economy, still on the league of a developed economy. So then both the tax treaties or the tax administration sat together and said that India will also get a right to tax the capital gains. तो अगर अपन इंडिया मॉरिशस की टैक्स ट्रीटी खोल के देखें तो उसमें इंडिया हैज द राइट टू टैक्स कैपिटल गेन्स, एंड द सो कॉल्ड फेमस मॉरिशस रूट इज नो लॉन्गर अ वैलिड रूट। इसके अलावा अभी भी एक दो कंट्रीज है जहां से नो टैक्स का अलग है टैक्स ट्रीटी में जो लैंग्वेज लिखी है, बट मॉरिशस इज नो लॉन्गर अ प्रेफर्ड टैक्स रूट फॉर कमिंग इनटू इंडिया, because India has also a right to tax. Otherwise, पहले जितने भी तुम न्यूज आर्टिकल देखोगे 2010, 11, 12, 13, 14, सबसे ज्यादा एफडीआई कहां से आता था? मॉरिशस से आता। उसका रीजन ये था क्योंकि इंडिया के पास राइट नहीं था टू टैक्स कैपिटल गेन्स, which has changed in 2017. Now India also has a right to tax capital gains. So this is a tax treaty, मतलब लाइव टैक्स ट्रीटी का एग्जांपल है जहां पे इंडिया मॉरिशस के रिलेशंस को देखते हुए ट्रीटी अमेंड भी हुई, इंडिया के फेवर में भी आई, और इंडिया ने एक बार टैक्स राइट फोरगो भी किया और सुप्रीम कोर्ट ने उसको वैलिड किया। यस, जो इंडिया ने फोरगो किया, that was a valid forego. You cannot compel a non-resident Mauritius taxpayer to pay taxes in India.
Now moving on to the next article, which is Article 23. It is dealing in elimination of double taxation. It has two methods: exception method and credit method. Under exception method, that particular income is completely exempted from that particular income of that person. And in the credit method, a person get a certain amount of credit under that method, which he has paid the credit in a source country. A tax paid in source country. First is definition of exemption income. Exemption method. Where a resident of a contracting state derives income or owns capital, which in accordance with the provisions of this convention may be taxed in the other contracting state if first mentioned state shall, subject to the provisions of paragraph 2 and 3, exempt such income or capital from tax. The UN model has exactly same definition as the OECD model. In India, uh, they do not follow the full exemption income. They rather follow credit method. The para 2, where a resident of a contracting state derives items of income which, in accordance with the provisions of Article 10 and 11, may be taxed in other the first mentioned state, shall allow a contracting state a deduction from the tax on the income of that resident an amount equal to the tax paid in other state. Such deduction shall not, however, exceed that part of the state tax as computed before the deduction is given, which is attributable to such income, items of income derived from that state. So there is a slight difference in definition of UN model. UN model also includes Article 12. Moving on to para 3, where in accordance with any provision of convention, income derived or capital owned by a resident of contracting state is exempt from tax in that state. Such state may nevertheless, in calculating the amount of tax on the remaining income or capital of such resident, take into account the exempted income or capital. Para 4, the provision para 1 shall not apply to income derived or capital owned by a resident of a contracting state where the other contracting state applies the provisions of a convention to exempt such income or capital from tax or applies the provisions of para 2 of Article 10 or 11 to such income. Article 23A, para 4 intends to avoid double non-taxation of income where the two contracting parties differ on the fact of case or on the interpretation of treaty provisions. It provides that where the state of source does not tax on income on account of certain interpretation of the convention, resident state has the right to tax such income or capital. However, state of residence must exempt income where source state has the right to tax an item of income or capital, but it had not imposed such tax since no tax is actually payable on such income or capital under its domestic laws. Now moving on to next method, which is credit method. Definition under OECD model is where a resident of a contracting state derives income or owns capital, which in accordance with the provisions of this convention may be taxed in the other contracting state, the first mentioned state shall allow a deduction from the tax on the income of that resident an amount equal to the income tax paid in other state, as deduction from the tax on the capital of that resident amount equal to the capital tax paid in that other state. Such deduction in either case shall not, however, exceed that part of the income tax or capital tax as computed before the deduction is given, which is attributable as the case may be to the income or the capital may be taxed in that other state.
So if you read line by line, where a resident of a contracting state derives income or owns capital. So first is resident of a contracting state. So that means resident of, for example, US. If we read it, so where a resident of US derives income, which in accordance with the provisions of India-US DTAA may be taxed in India. Other contracting state from the India. The first mentioned state, US, shall allow. US क्या करेगा? A deduction from the tax on the income of that resident. उसको एक deduction देना पड़ेगा जो भी वहाँ पे domestic law के हिसाब से जो tax लगता है उसको किसका deduction देना पड़ेगा? Of an amount equal to tax paid in the other state. तो जो इंडिया में टैक्स पे कर दिया उतने का टैक्स का यूएस को डिडक्शन देना पड़ेगा. बाय दिस डबल टैक्सेशन अवॉइड हो गया क्योंकि एक ही जगह टैक्स गया. उसने इंडिया में टैक्स पे कर दिया, यूएस में भी टैक्स लगा, लेकिन यूएस ने क्या किया कि जो इंडिया में टैक्स पे कर दिया उसका डिडक्शन दे दिया, केवल बैलेंस के ऊपर ही टैक्स लगा. अब एक सिनेरियो ये हो सकता है कि जैसे इंडिया में लगा 20% टैक्स और यूएस में तो केवल 10% टैक्स ही लगता है, तो क्या यूएस जो एडिशनल 10% इंडियन गवर्नमेंट को दिया हुआ है क्या उसको रिफंड करेगा? क्यों? ज्यादा टैक्स दिया ना, यूएस को रिफंड करना चाहिए. क्यों नहीं करेगा यूएस रिफंड? क्या treaty में नहीं, सामने ही लिखा हुआ है. However, such deduction in either case shall not exceed that part which is attributable to the income which has been taxed in the other state. तो उसके अंदर लिमिट कर दिया कि उसको जो डिडक्शन दिया जाएगा वो उतना ही दिया जाए, उतना ही मिलेगा जितना की टैक्स लायबिलिटी है. सो कभी भी रिफंड का सिनेरियो अराइज नहीं होगा. सो दिस इज और मोस्ट ऑफ द टैक्स ट्रीटीज में क्रेडिट मेथड है कि एग्जम्पशन मेथड तो हो गया कि इंडिया ने टैक्स लगा दिया तो दूसरी कंट्री ने बोल दिया कि मैं एग्जाम कर दी तो इस इनकम को इसको इंक्लूड नहीं करूंगा. मोस्ट ऑफ द टैक्स ट्रीटीज में 99 टैक्स ट्रीटीज में 99% टैक्स ट्रीटीज में लिखा हुआ नहीं है, सब जगह क्रेडिट मेथड ही है. और क्रेडिट मेथड का मतलब ये होता है कि एक जगह टैक्स दे दिया तो उसका क्रेडिट मिल जाएगा दूसरी कंट्री के. एंड इंडिया के अंदर जो इनकम टैक्स एक्ट है देयर इज अ रूल व्हिच इज 128 ऑफ द इनकम टैक्स रूल्स जो कि मैकेनिज्म भी देता है कि कैसे आप कंप्यूट करोगे टैक्स क्रेडिट, क्योंकि मोर और लेस प्रिंसिपल इसी के ऊपर बेस्ड. सो दिस इज अ क्रेडिट मेथड टू अवॉइड डबल टैक्सेशन.
Basically, the slide is the easier, it is defined in easier words. So determine the resident's worldwide income and compute tax liability. Grant a deduction in respect of foreign tax paid on the foreign sourced income as under. If tax payable in country of residence is more than taxes paid in source country, then differential tax has to be paid in residence country. If tax payable in residence country is less than taxes paid in source country, then excess credit tax credit may be carried forward or lapsed. In India, such excess credit lapses. Now, moving on to the para 2, where in accordance with any provision of convention, income derives or capital owned by a resident or of contracting state is exempt from tax in that state. Such state may nevertheless, in calculating the amount of tax on the remaining income or capital of such resident, take into account the exempted income or capital. Moving on to the next slide, the topic is non-discrimination, and this is covered under Article 24. This states that neither of the contracting states give preferential tax treatment in taxing its own residents, citizens, and foreign persons in the same circumstances. इसका मतलब कोई भी अगर दो कॉन्ट्रैक्टिंग स्टेट्स है तो वो डिफरेंशिएशन नहीं करेंगे अपने टैक्स रेसिडेंट को टैक्स करने में या फॉरेनर्स को टैक्स करने में. Similar situation shall not be treated differently unless differentiation is justified. अगर डिफरेंशिएशन जस्टिफाइड है तो कर सकते हैं वरना नहीं. Article 24 convention deals with certain cases of non-discrimination such as based on nationality, status person, based on PE, and deductibility of interest, royalties, and other disbursements, and based on ownership.
So tell me one thing. Foreign company के ऊपर क्या tax rate है?
30%.
40%. Domestic company में 30%. So is it a discrimination?
सर जस्टिफाइड है तो कर सकते हैं अगर कोई जस्टिफिकेशन है उसका.
बट सरचार्ज डिफरेंट है. डोमेस्टिक कंपनी में ज्यादा है, फॉरेन कंपनी में कम है. बेस टैक्स रेट में भी तो फर्क है ना. डोमेस्टिक कंपनी में 30% है या 22% है, राइट? 25-26 भी डिपेंडिंग अपॉन द टर्नओवर. लेकिन फॉरेन कंपनी में 40% का टैक्स है, तो डिस्क्रिमिनेशन हुआ ना. Will this article come to rescue? इसी वाले साइड पर इसमें लिखा हुआ है if they are in the same circumstances, whether a foreign company and a domestic company is in the same circumstance. The answer is no, because they are different tax regimes. The status by virtue of the domestic law is different. An Indian company and a foreign company, they are not in the same circumstances, and therefore the court held that higher rate of tax for foreign companies are valid tax rate. Because it went into litigation कि foreign company के ऊपर 40% क्यों rate लगता है? This is a discrimination. But court held that this is not a discrimination because you are not operating in the same circumstances. That's logic for this. Therefore, जो word है in the same circumstances very important to understand. one of the live example is 30% versus 40% tax rate.
So next is non-discrimination based on nationality is covered under paragraph 1. This paragraph provides that nationals of two contracting states must be treated at par for tax purpose. That is, tax on non-residents must be same as imposed under the domestic laws on its own nationals. Next is non-discrimination with respect to stateless persons is covered under paragraph 2. It is not generally present in Indian treaties. Next is non-discrimination based on permanent establishment covered under paragraph 3. Equal treatment must be given to permanent establishments for deduction of expenses, loss, carry forward, depreciation and capital gain computations, and ensures that enterprise of one contracting state carrying on business activities in other contracting states through PE are not subject to less favorable taxation or treatment compared to enterprise of other contracting states carrying on similar activities. Next is non-discrimination based on deductibility of interest, royalties, and other disbursements for determining taxable profits is covered under paragraph 4. In this, equal treatment in regard to such deduction while determining taxable profits of the residents of source state deduction condition should be same and ensures that resident and non-residents of the contracting states are treated equally. Next is non-discrimination based on ownership is covered under paragraph 5. All resident companies should be treated equally for tax purposes, whether they are owned by resident companies or by one or more other than resident companies. Let's have a case study. XAG एक लिस्टेड कंपनी है जर्मनी में, वो मर्ज हो गई ZEG एक लिस्टेड कंपनी के साथ. उनकी एक XAG की एक सब्सिडरी है वाई प्राइवेट लिमिटेड इंडिया में, और वाई प्राइवेट लिमिटेड के पास बहुत टैक्स लॉसेस हैं. तो इसमें क्वेश्चन इज whether provisions of section 79 are applicable. If yes, whether there is non-discrimination. तो सेक्शन 79 सबसे पहले सिर्फ प्राइवेट कंपनी में लगता है, पब्लिक कंपनी में नहीं. और इसके अकॉर्डिंग अगर किसी भी प्राइवेट कंपनी की शेयर होल्डिंग में मोर देन 50% से ज्यादा चेंजेस हैं शेयर होल्डिंग में, तो वो अपने लॉसेस कैरी फॉरवर्ड या अपने नहीं कर सकता, और अगर नहीं है तो कर लेगा. और ये वाला बेनिफिट पब्लिक कंपनी को तो मिल ही जाएगा कैरी फॉरवर्ड करने का, सेट ऑफ करने का. तो इस केस में इस वाई प्राइवेट लिमिटेड को एक्वायर करा था ZXAG ने, अब उसकी मर्ज हो गई वो ZAG से, तो उसकी शेयर होल्डिंग में चेंज आ गया. तो इस अकॉर्डिंग सेक्शन 79 डिस्क्रिमिनेशन कर रहा है, तो सेक्शन 79 को ओवररूल कर लेगा आर्टिकल 24 पैराग्राफ 5 नॉन डिस्क्रिमिनेशन के लिए. और अब 2001 के बाद सेक्शन 79 में अमेंडमेंट आ चुका है कि अब ऐसा नहीं होगा, प्राइवेट कंपनी कर सकती है ज्यादा. नेक्स्ट इज प्रोटोकॉल. The protocol to a tax treaty explains or modifies the provisions of the tax treaty. A protocol clarifies certain provisions or adds new provisions in the original treaty. Items typically covered by protocols are scope of PE, computation of business profits, scope of taxation of royalties, fees for technical services, most favored nation clause, and taxation of capital gains. इसकी examples भी हैं important protocols की, such as India-US tax treaty में explanation of make available principle, that India-France tax treaty में MFN clause. Next is steps while referring to tax treaties. Step 1, determine the scope of convention. सबसे पहले ये define करना पड़ेगा कि taxpayer is a person or resident of a contracting state as per article 4 paragraph 1. और treaty apply होता है taxes को जो covered होते हैं article 2 में. Applicability of treaty to taxable person और treaty के effect to domestic laws of the concerned state. Next step is to apply relevant definitions as given in various articles. Next step is application of substantive provisions such as process of characterization, change in character of company, or change in character due to PE, that is royalty, could be taxable under business profits clause also, and commentaries to the model convention, case law, etc. Step 4, apply the substantive articles. Step 5, apply provisions of double taxation. Step 6, follow treaty provisions into domestic law, that is apply mechanism for obtaining tax credit to taxability of the income. Now next is foreign.
Previously, so ये तो broadly steps जो लिखे हुए ये तो है. Practically ये इसके साथ साथ क्या होता है कि for example कोई भी हमारे पास भी एक 15 CA CV बनाना जरूरी होता है whenever a foreign remittance has to be made. Section 195 है, वो कहता है कि if a foreign remittance has to be made, then it cannot be made without furnishing Form 15 CA or CB. Form 15 CB क्या है? It is a certificate of a chartered accountant certifying whether that income is chargeable to tax in India or not. If it is chargeable to tax in India, तो वैसा सर्टिफिकेट देना, नॉट चार्जेबल है तो वो वैसा सर्टिफिकेट देगा और लिखेगा क्या रीजन है फॉर नॉट गेटिंग इट चार्ज टू टैक्स इन इंडिया, एंड उसके बाद ही पेमेंट जाता है। सो व्हेनेवर कोई भी जैसे फॉरेन रेमिटेंसेस आउट ऑफ इंडिया जाते हैं तो 15 सीबी की रिक्वायरमेंट्स आती है। वी आल्सो प्रिपेयर 15 सीबीज। 15 सीबीज के अंदर हम ये इवैल्यूएट करते हैं कि सबसे पहले क्या टैक्स ट्रीटी लगती है नहीं लगती। उससे पहले क्या होता है, सबसे पहला स्टेप है वेदर टैक्स पेयर इज अ पर्सन, तो जिसको पेमेंट जाना है, जो रेसिपिएंट है उस इनकम का, वेदर दैट इज अ पर्सन। मोस्ट ऑफ द केसेस में यस, बिकॉज एक कंपनी होती है या इंडिविजुअल होता है, वो होता है। टैक्स पेयर इज अ रेजिडेंट ऑफ अ कॉन्ट्रैक्टिंग स्टेट, वो वहां का रेजिडेंट है या नहीं है, इसलिए क्या डॉक्यूमेंट लेना होता है, टीआरसी, टैक्स रेजिडेंसी सर्टिफिकेट। बिना टैक्स रेजिडेंसी सर्टिफिकेट के ऊपर आप पीटी के ऊपर तो जा ही नहीं सकते हो, बिकॉज दैट इज अ डॉक्यूमेंट विच इज अ प्रूफ गिवन बाय अदर कंट्री कि वो वहां का रेजिडेंट है। इंडिया भी टीआरसी इशू करता है, जो इंडियन गवर्नमेंट है वो ये टीआरसी इशू करता है, वो सर्टिफाई करता है कि यस अ प्राइवेट लिमिटेड कंपनी इज अ रेजिडेंट ऑफ इंडिया। उसके लिए इनकम टैक्स लॉ के अंदर रूल्स बने हुए हैं कि आपको एक एप्लीकेशन देना पड़ता है अपने जुरिसडिक्शनल असेसिंग ऑफिसर को। असेसिंग ऑफिसर उसको वेरीफाई करेगा, वेट करेगा और फिर एक सर्टिफिकेट इशू करेगा दैट यस दिस प्राइवेट लिमिटेड कंपनी और कंपनी इज अ रेजिडेंट ऑफ इंडिया, या आई एम एन इंडिविजुअल, मैं भी टीआरसी के लिए अप्लाई कर सकता हूँ इंडिया में। उस फॉर्म में फिल करके मैं बोलूंगा कि गिव मी अ सर्टिफिकेट, तो चेक करेंगे कि क्या मैं 182 डेज से ज्यादा रहा है या नहीं रहा। उसके लिए मैं क्या दूंगा, पासपोर्ट की कॉपी दूंगा मैं, कि उसके अंदर अगर कोई ठप्पा नहीं लगा और मैं इंडिया में ही रहा हुआ 182 डेज से ज्यादा, तो आई एम अ रेजिडेंट ऑफ इंडिया, तो दे विल इशू मी अ टीआरसी ऑफ इंडिया। सिमिलरली जो सेकंड स्टेप है, टैक्स पेयर इज अ रेजिडेंट ऑफ अ कॉन्ट्रैक्टिंग स्टेट, इसलिए हम क्या मांगते हैं, अगले की टीआरसी दो कि आप रेजिडेंट हो भी या नहीं हो, तभी तो हम पीटी लगाएंगे, नहीं तो लगा ही नहीं सकते। तीसरा है इट अप्लाइज टू टैक्सेस कवर। जनरली जो टैक्सेस कवर होते हैं उसके अंदर वो बिजनेस टैक्स या कॉर्पोरेट टैक्स कवर होता है, तो मोर और लेस ये लगता है। एप्लीकेबिलिटी ऑफ अ टैक्स ट्रीटी टू अ टैक्सेबल पीरियड, ये भी कवर होता है क्योंकि हर एक पीरियड को कवर करता है ये टैक्स ट्रीटी। एंड ट्रीटी इफेक्ट टू द डोमेस्टिक लॉज ऑफ द कंसर्न स्टेट। देन स्टेप 2 इज द अप्लाई रेलेवेंट डेफिनेशन, टाई ब्रेकर नहीं लगा, ये सब नहीं लगा। फिर स्टेप 3 के अंदर आते हैं एप्लीकेशन ऑफ सब्सटैंशियल प्रोविजंस, कि वो किस नेचर की इनकम है। फॉर एग्जांपल रॉयल्टी फी फॉर टेक्निकल सर्विस, तो फी फॉर टेक्निकल सर्विस वाला हमने आर्टिकल को अप्लाई किया, हमने उस आर्टिकल को पढ़ा, उसमें अच्छा ठीक है दिस इज अ फी फॉर टेक्निकल सर्विस, क्योंकि फी फॉर टेक्निकल सर्विस डिफाइन किया हुआ है डीटीडब्ल्यूए, उसकी डेफिनेशन के हिसाब से वी कंक्लूडेड दैट यस इट इज आल्सो अ फी फॉर टेक्निकल सर्विस एंड चार्जेबल टू टैक्स। टीआरसी भी मिल गई, सब्सटैंटिव प्रोविजन अप्लाई किया तो लगा कि हाँ ये फी फॉर टेक्निकल सर्विस है, टैक्सेबल है, इंडिया में टैक्सेबल है। फिर उस ट्रीटी में पढ़ा, उसमें लिखा हुआ है कि ओके द टैक्स रेट शुड नॉट एक्सीड 10%, तो इंडिया कितना टैक्स रेट लगाएगा, 10%। अब क्वेश्चन क्या है, सरचार्ज और सेस इंक्रीज होएगा इस टैक्स रेट से? The answer is no because this is a final rate. उसके बाद apply substantive article provisions of the double taxation and follow treaty provisions into domestic law. ये सब देखते हुए हमने बोला कि 15 सीबी बनाया कि ओके दिस इज चार्जेबल टू टैक्स एट 10%, और जो पेयर है, जो इंडियन रेजिडेंट है, जो पे करता है, वो पे करते समय 10% की विथहोल्डिंग करेगा, इंडियन गवर्नमेंट को जमा करा देगा, और 90% जो पैसा है वो रेमिट हो जाएगा। हमने क्या क्या डॉक्यूमेंट्स लिए, टीआरसी, इसके साथ साथ नो पी सर्टिफिकेट कि उसका परमानेंट एस्टैब्लिशमेंट इंडिया में नहीं है। अगर परमानेंट एस्टैब्लिशमेंट इंडिया में होगा तो बिजनेस प्रॉफिट की तरह टैक्स होगा, इसलिए नो पी सर्टिफिकेट हर केस में हम लेते ही लेते हैं। और तीसरा होता है फॉर्म 10F। आजकल एक इलेक्ट्रॉनिक फॉर्म 10F की रिक्वायरमेंट आ चुकी है, वो भी सेक्शन 90 से निकल के आता है। आई एम नॉट गोइंग इनटू डीप फॉर फॉर्म 10F, बट these are the 3 basic documents which has to be collected when a tax treaty is being applied. TRC, no fee certificate and फॉर्म 10F। अगर ये कागज नहीं है तो हम टैक्स ट्रीटी पे नहीं जा सकते। और इसमें सबसे इंपॉर्टेंट डॉक्यूमेंट कौन सा है, टीआरसी, which certifies कि अगला पर्सन इज अ टैक्स रेजिडेंट ऑफ द अदर स्टेट। तभी तो हम ट्रीटी में जाएंगे, बिकॉज ट्रीटी की फर्स्ट लाइन क्या लिखी थी, इफ अ पर्सन इज अ रेजिडेंट ऑफ वन और मोर ऑफ द कॉन्ट्रैक्टिंग स्टेट। तो रेजिडेंट ऑफ अगले कॉन्ट्रैक्टिंग स्टेट हमें थोड़ी ना पता है, वो तो वहां का कोई सर्टिफिकेट लाके देगा तभी जाके पता चलेगा। सो ऐसे पता चलेगा। फिर हमने पेमेंट कर दिया 90% का और उसको टैक्स सर्टिफिकेट दे दिया। अब जो उसको इनकम मिल गई वो वहाँ के डोमेस्टिक लॉ के हिसाब से भी टैक्स होएगा। फॉर एग्जांपल वहाँ के डोमेस्टिक लॉ के हिसाब से उस इनकम के ऊपर उसकी तो बिजनेस इनकम बनी, बिजनेस इनकम में से खर्चे काट कूट के जो बैलेंस इनकम है उसके ऊपर टैक्स कैलकुलेट किया। उसको कंपेयर करेंगे विद इंडिया टैक्सेस। अगर इंडिया में टैक्स मैंने ज्यादा दे रखा है तो उसकी क्रेडिट मिल जाएगी उसको वहाँ पे, और केवल रिमेनिंग टैक्स ही वहाँ पे पे हुआ। सो प्रैक्टिकली पूरा सिनेरियो ऐसे वर्क करता है। क्रॉस बॉर्डर पेमेंट्स तो एवरीडे होते ही होते हैं, और उसके लिए जो एक 16 CA का सर्टिफिकेट होता है, that is a mandatory certificate that has to go with all the foreign remittances.
Next is foreign tax credit. It's a tax relief mechanism provided by many countries to alleviate the burden of double taxation on income that has been taxed in foreign jurisdiction. The concept of FPC is especially significant in context of international taxation, where individuals and businesses may earn income in multiple countries and could potentially be subject to taxation by each of those countries. Let's have a look at the case study. So, एक इंडिविजुअल है वो फॉरेन इनकम कमा रहा है, इंटरेस्ट और रॉयल्टी 1000 ईच, और टैक्स लायबिलिटी उसकी फॉरेन इनकम पे बन रही है 300 and 300 ईच इनकम, और उसी इनकम पे इंडिया पे टैक्स बन रहा है इंटरेस्ट पे 250 और रॉयल्टी पे 350. तो फॉरेन टैक्स क्रेडिट के अकॉर्डिंग और ये ट्रीटी के अकॉर्डिंग हम एक इनकम को 2 बार टैक्स पे कर सकते हैं. तो जो उसने फॉरेन में टैक्स पे कर दिया तो वो इंडिया में दोबारा पे नहीं करेगा और इंडिया में उसे क्रेडिट मिल जाएगा. तो उसने फॉरेन में पे किया इंटरेस्ट पे 300 का और इंडिया में उसे 250 की लायबिलिटी बन रही है, तो क्रेडिट से उसे 250 का मिलेगा, उससे ज्यादा का नहीं. तो इस अकॉर्डिंग टैक्स पेबल इन इंडिया 50 रुपीज का उसे देना पड़ेगा. सिमिलरली रॉयल्टी इनकम पे सिर्फ फॉरेन में 300 का टैक्स पे किया है और इंडिया में उसकी 350 की टैक्स लायबिलिटी बन रही है, तो वो क्रेडिट 300 का ले सकता है और 50% का उसका अनयूटिलाइज्ड फॉरेन टैक्स क्रेडिट इंडिया में भी रह जाएगा. Now let's have a look at some more case studies. Case study 1 is based on partnership. LKP is a partnership that has rendered service to its client in country S और उसके पार्टनर से A and B. वो कंट्री R में है LKP और कंट्री S में उसने सर्विसेज रेंडर करी है, और कंट्री R कंसीडर करता है पार्टनरशिप को फिस्कली ट्रांसपेरेंट, बल्कि कंट्री S पार्टनरशिप को टैक्सेबल मानती है. So who can claim treaty benefits? So what is fiscally transparent? फिस्कली ट्रांसपेरेंट एक ऐसा टर्म है जो हम यूज करते हैं टैक्सेशन में, डिस्क्राइब अ लीगल एंटिटी जिसमें लीगल एंटिटी टैक्सेबल नहीं होती बल्कि इसके मेंबर्स, पार्टनर्स, ट्रस्ट के मेंबर्स जो होते हैं वो सब टैक्सेबल होते हैं. तो इन दिस केस एलकेपी कंट्री आर में है और कंट्री आर फिस्कली ट्रांसपेरेंट मानती है पार्टनरशिप्स को, तो पार्टनरशिप्स में वो एलकेपी जो होगी कंट्री आर में टैक्सेबल नहीं होगी, इसके पार्टनर्स टैक्सेबल होंगे, और कंट्री एस में वो इनकम अर्न कर रहा है. तो अब इन दोनों की ट्रीटी के अकॉर्डिंग और कंट्री आर के रूल के अकॉर्डिंग जो बेनिफिट होगा वो कंट्री आर के पार्टनर्स को मिलेगा क्योंकि वो टैक्स पे करेंगे. Same is written here. Partners will avail the benefits. Moving on to next case study, which is based on resident. Mr. A citizen है USA के, वो इंडिया गए परमानेंट काम करने के लिए 3 years के टर्म के लिए. उनका यूएस में भी एक घर है और इंडिया में भी है. यूएस का अगर उन्होंने रेंट पर दे रखा है, इंडिया में उनका परमानेंट एस्टैब्लिशमेंट अभी है, तो उनका टैक्स रेसिडेंशियल स्टेटस क्या होगा इंडिया यूएस ट्रीटी के अकॉर्डिंग. तो मिस्टर एक्स का परमानेंट होम इंडिया में भी है, यूएस में भी है, बट अभी उनका परमानेंट होम इंडिया में है, उनके इनवाइटेड इंटरेस्ट में इंडिया में लाई कर रहे क्योंकि वो वहाँ पे जॉब कर रहे हैं. तो इस अकॉर्डिंग वो इंडिया और यूएस की ट्रीटी के अकॉर्डिंग इंडिया के रेसिडेंट माने जाएंगे. नाउ नेक्स्ट इज अबाउट लायबल टू टैक्स एंड सब्जेक्ट टू टैक्स. एओपी एक है कंट्री आर में, उसने अपने शेयर्स बेच दिए जो कि इंडियन कंपनी के थे और उससे कैपिटल गेन हुआ. एओपी के पास एक वैलिड टैक्स रेसिडेंसी सर्टिफिकेट है कंट्री आर का, आर और एस की टैक्स ट्रीटी के अकॉर्डिंग कैपिटल गेन एग्जेम्प्ट होता है. तो वेदर ट्रीटी बेनिफिट्स विल बी अवेलेबल टू एओपी. इसके अकॉर्डिंग सिंस टैक्स फर्स्ट ऑफ ऑल टीआरसी से डॉक्यूमेंट का सर्टिफिकेशन एक कंट्री के टैक्स अथॉरिटी इशू करते हैं उसे एक वैलिड रेसिडेंट का सर्टिफिकेट देने के लिए. तो उस अकॉर्डिंग एओपी एक वैलिड रेसिडेंट हो गया कंट्री आर का, और वो जो भी कैपिटल गेन कमाएगा वो एग्जाम्प्ट हो जाएगा उसकी कंट्री के रूल से, और सिमिलरली आर और एस के टैक्स ट्रीटी के अकॉर्डिंग भी वो एग्जाम्प्ट होगा. तो इसलिए benefit will be available to AOP and same is written here. Yes, convention applies to foreign AOP.